Welcome. Thank you for joining us today. My name is Peter Toll, the Office Managing Partner for Perth and International Liaison Partner, and I'm delighted to welcome you to today's session. Today we are hosting our biannual Natural Resources Accounting Update, and before we begin proceedings, I'd like to acknowledge that we're hosting this meeting on the traditional lands of the Noongar people. We pay our respects to them and their cultures and elders both past and present. There is still lots of uncertainty in the world in terms of what has happened with COVID, and in the natural resources world, there are companies that are unaffected and some in a great way, either positively or negatively. This morning we will talk about the financial reporting implications of COVID and get you ready and prepared for the upcoming lot of accounts at 31 December. Today we have Ashley and Kay talking you through getting your reports ready, and towards the end of the webinar, we have Alan Hand who will discuss important tax changes and how COVID has affected taxpayers. Without further ado, I'd like to now pass you over to Ashley to get you underway, and I hope today is a good session. Thank you.
Thank you, Peter, and good morning, everyone. Thanks for joining us today on this webinar. As Peter said, this morning we are going to discuss the ongoing financial reporting implications as a result of the coronavirus pandemic, as well as touch on those standards and interpretations which have only recently been adopted or are being adopted this year. Looking at the changes to the definition of a business in AASB 3, which is effective from 1 January 2020. We will then follow this with a short update on tax presented by Alan Hand from BDO's tax team. As we are going through the presentation, please feel free to raise any questions via the question box, and we will try to address them as they arise. Otherwise, we will respond individually after the webinar. So the implications of the coronavirus pandemic around the world. When we last presented an accounting update 6 months ago, there was an awful lot of uncertainty around what would happen both in Australia and globally, and what this would mean for the economy. Well, 6 months on, and we have been very lucky here in Perth, and a vaccine may be on the horizon, but there remains a lot of uncertainty around the world, including as to the longer-term impacts on the economy, how fast and what shape will the recovery be. Our advice last time was that all the uncertainties should lead in your financial reports to increased disclosures. And this could be both in the specific significant judgments and estimates notes, but also in relation to specific areas such as impairment, which would be impacted by these uncertainties. And I think the same could be said at December. Disclosures around judgmental areas will continue to be very important. In the session today, we will look at specific areas which are more likely to have been impacted by the coronavirus, in particular impairment and going concern, and also specific guidance in relation to leases, as the IASB and AASB issue amendments to the leases standard in response to the pandemic. We will also look at what next post-implementation for AASB 16, and also other newly adopted or soon to be adopted standards, Interpretation 23, uncertainty over income tax treatments, and amendments to the definition of a business in AASB 3. Turning to our first topic, impairment. When we think of impairment, we first think of the standard on impairment of non-financial assets, AASB 136. And then also AASB 9 in relation to the impairment of financial assets. You will see I have included exploration and evaluation assets on this slide. And whilst whether an impairment test needs to be undertaken is governed by AASB 6, if an impairment test is required, then it is 136 which must be applied. AASB 136 also applies to PP&E, intangible assets, and possibly for the first time, right-of-use assets recognised under the new leasing standard. In particular, if on transition you adopted the practical expedient to use a previous assessment of whether a lease was an onerous contract instead of carrying out a full impairment test, you will be considering impairment of these right-of-use assets for the first time, and care will be needed as to how these right-of-use assets and the related lease payments should be included in your impairment models. Turning to financial assets, AASB 9 contains the impairment requirements for these, but also for contract assets recognised under AASB 15, and also financial guarantee contracts and loan commitments. Sorry about that. It's also worth remembering that impairment needs to be considered in relation to other standards as well, even if it is not described as such. For example, inventories, associates and joint ventures where there are a number of impairment-related considerations, and income taxes, in particular the recoverability of deferred tax assets. So what is ASIC expecting in terms of impairment? ASIC's recent media releases emphasise the importance of focusing on asset values in these uncertain times. For non-financial assets, entities adversely impacted in the current environment may have indicators of impairment that require impairment testing to be performed. Specific guidance released from ASIC states that, given uncertainties, it may be necessary to use probability-weighted scenarios in making estimates of both fair value and value in use. In those cases, modelling risks may still need to be factored into the discount rate used in the discounted cash flow model. For financial assets, ASIC's guidance is that past models and historical experience may not be representative of current expectations. This applies to all loans and receivables, including loans to associates and also trade receivables. A probability weighting of possible scenarios may also be needed in these assessments. ASIC's key message: clear disclosures around the business impacts and uncertainties is vital. Looking now at AASB 136 and when we are required to test non-financial assets for impairment. Goodwill and indefinite life intangibles must be tested for impairment at least once a year, and other non-financial assets whenever there is an indicator of impairment. For those of you with a June year end, chances are impairment testing was undertaken during your June reporting period. The challenge now is to see how the assumptions made during such an uncertain time have stacked up. If plans have not panned out as expected and economic performance of a certain asset or group of assets is worse than expected, then this is an impairment indicator that will require you to conduct another impairment test. Or alternatively, if impairment was recognised in the June year end and the actual performance is better than expected, a reversal of the impairment may be required. Noting that the reversal is not allowed for any previously impaired goodwill. For our December year-end entities who are not required to report on their half year at June, this is likely to be the first time you are required to factor COVID uncertainties in your reporting. Given the significant changes in the environment since last December, it is likely that external and/or internal impairment indicators are present and impairment testing will be required. The slide includes other impairment indicators that are particularly relevant in times of uncertainty. And of course, paragraph 12D of AASB 136, which we come across a lot. If you are listed and your market capitalisation is less than your net asset position, this is an indicator that you need to look at your asset values and test them for impairment.
So, Ash, what about junior explorers with net assets less than their market capitalisation? They may have other AASB 6 impairment testing triggers too.
Yes, good point, Kay. And this is a question that we come across regularly. So the standard answer in this situation is that it does depend, but usually, yes, this is generally an impairment indicator that should be considered along with other internal indicators. For exploration assets, even though AASB 6 has specific impairment indicators, the standard is clear that the conditions listed in paragraph 20 is not exhaustive. So for situations where there is a market cap deficit, this may require impairment testing be performed in line with requirements under AASB 136. In these situations, if you have a single asset, in practice, you would likely look to your market cap as an indication of the fair value less cost to sell recoverable amount. Depending on other assumptions applied to adjust the fair value assessment, this could be a level 3 valuation, which requires more judgment and more detailed disclosures. So probably not the answer you wanted, Kay, but hopefully provides clarity and explains the interaction between AASB 6 and 136.
Thanks, Ash.
Okay, so further on from that, so when is an asset impaired? Well, when its recoverable amount being the higher of its value in use and its fair value less cost of disposal is less than its carrying amount. In this situation, the asset must be written down to its recoverable amount. And if the asset is being tested as part of a CGU, then the overall impairment loss must be allocated to the assets within the CGU, starting first with intangibles. Cash flows included in either a value in use or a fair value less cost of disposal calculation need to consider all available information. Given the disruption to operations, the cash flow forecast will need to incorporate extremely severe downside forecasts, and the effect would vary depending on industry sector and location of operations. Turning now to financial assets, expected credit losses may increase due to an increase in both the probability of default and the loss given default for financial assets. As all financial assets subject to expected credit losses require the probability of default to be estimated over the next 12 months, the effects of uncertainty relating to coronavirus may be very significant. Additionally, the effects of the coronavirus may trigger a significant increase in credit risk, particularly if your customer base is international, and therefore the recognition of a lifetime expected credit loss provision on many financial assets. For equity accounted investments, before applying the equity method, an entity must first recognise expected credit losses in accordance with AASB 9 if an investment in associate or joint venture includes a long-term interest that is subject to expected credit loss. For example, if there is a loan to the investee. After an investor has recorded its share of income from an associate or joint venture, as required by the equity method, the remaining carrying value of the investment is still subject to further impairment requirements. An entity then applies AASB 136 to the remaining carrying value. After the carrying value of an interest in an associate or joint venture is reduced to zero, additional losses and a liability are accounted for if the investor has a legal or constructive obligation to make payments on behalf of the associate or joint venture. The effects of the COVID-19 outbreak may make this type of arrangement more common. For deferred tax assets, an assessment of the likelihood of an entity being able to recover the value of deductible temporary differences needs to consider all available information. Given the disruption to operations, forecasts may need to incorporate extremely severe downside forecasts. Tax losses and other deductible temporary differences having no fixed expiry or a very long-term expiry is not justification for the recognition of associated deferred tax assets. Our concluding comments on impairment are that we still expect an increase in the number of assets and CGUs that will require impairment testing. Multiple scenario analysis is still likely to be the most accurate way to reflect future cash flows, and enhanced clear disclosures are vital. I will now hand over to Kay, who will take you through modification to leases and share-based payments.
Thank you, Ash, and good morning, everyone. Turning now to an area where the IASB and subsequently the AASB has made changes to an accounting standard in response to the coronavirus pandemic. Barely was the ink dry on the first time application of the new leases standard, then it has been amended. And this was in large part due to the newness of that standard. The IASB recognised that the first time adoption of AASB 16 had been challenging, as many companies struggled to assess their many and diverse lease contracts. Add to this a global pandemic, resulting in government intervention around the world, either forcing or enabling landlords to provide rent relief in some form to tenants, and there was no time for anyone to catch their breath and indulge in a little bit of steady state. Instead, they were being asked to consider how to account for changes to their lease contracts. And whilst the initial response might be, well, the agreement has been changed, that is, it has been modified, so there must be a lease modification to account for, things were, of course, not that simple. What if the lease contract had foreshadowed changes to the lease payment in the event of a force majeure? Was there a lease modification then? And was a global pandemic a force majeure event? Now, if you only have one or two leases, it may not be too hard to answer these questions. But if you have many leases, all with different terms and conditions, you can see the amount of work to assess this rapidly multiplies. Recognising this, the IASB made amendments to IFRS 16, AASB 16 in Australia, to add a practical expedient to allow entities to shortcut their way through this analysis. But before we look at how the practical expedient works, let's first look at what the implications on your accounts may be if you do or don't use it. If the practical expedient is not applied, and the rent concession, for example, being the deferral or reduction in rent, is a lease modification, that is, it was not in the original terms of the lease, but does not either decrease the scope of the lease, then the lease liability will be remeasured to the present value of the revised lease payment using an updated discount rate. An equivalent adjustment is made to the right of use asset. This means there's no immediate impact on profit and loss. The effect is, instead, recognised through modified interest and depreciation going forward. Consider now the impact if the conditions for the practical expedient are met and it is applied. The lease liability is again reduced to reflect the revised lease payment. However, the discount rate used to calculate the lease liability is not updated. The original discount rate continues to be used. Assuming the rent concession is beneficial to the lessee, this will also result in a reduced lease liability, although the quantum of this will not be the same with lease modification accounting due to the different discount rates. The other side to the adjustment to the lease liability, if the practical expedient is being applied, is not to the right of use asset. Instead, it is to profit and loss. Depending on the facts and circumstances, this can be either immediately or over the period of the rent concession. The flowchart on this slide shows the conditions that need to be met for the practical expedient to be applied. Firstly, did the rent concession occur as a direct result of the COVID-19 pandemic? If not, the practical expedient can't be used. If it did occur because of the pandemic, then the next thing to consider is whether the change in lease payments has resulted in consideration that is substantially the same or less than before. Now, the standard isn't clear whether, in assessing this, you should use nominal, that is undiscounted, lease payments or discounted amounts to assess this. In our view, it would be appropriate to use discounting. As an example, if a rent concession defers 3 payments of monthly rent of $100 for a period of 12 months, and the lessor and lessee agree to increase the rent to, say, $105 per month when it is paid in 12 months, then provided this increase is only to compensate the lessor for the time value of money, then this criterion is satisfied. You then need to consider which payments are affected. How far out does the rent concession go? And note that if the concession goes out beyond June 2021, then the practical expedient can't be applied to any of the rent concession. That is, you can't split the rent concession and apply the practical expedient to rent reductions before June 2021 and lease modification accounting to rent reductions after that date. Then you also need to consider what else, if anything, has changed in the terms and conditions of the lease. For example, has the term been extended, perhaps to compensate for periods during lockdown when the asset could not be used? This was considered by the IASB whilst they were drafting the practical expedient, and the example they gave was that of a 3-month rental holiday before 30th of June 2021, followed by 3 additional months of substantially equivalent payment at the end of the lease. They concluded that this would not constitute a substantive change to the other terms and conditions of the lease. And finally, if you are going to apply the practical expedient, it needs to be applied for all similar leases. So assuming you can and choose to apply the practical expedient, what do you do? The practical expedient simply states that the rent concession is not accounted for as a lease modification. This will often result in changes in lease payments being accounted for as variable lease payments through profit and loss. The timing of when this is recognised will depend on the precise terms of the rent concession. For example, if the rent concession agreed is that rent for the period from July to December 2020 will be reduced by 15%, and this reduction is not conditional on any future events, then the benefit will be recognised in profit and loss when the concession is agreed. Conversely, if a landlord and retailer agree to a 15% reduction in rent for each of these months, but only if foot traffic in the shopping centre is down 15% on the prior year, then the benefit will only be recognised over the period July to December, once it is confirmed that foot traffic is reduced. And if you choose not to, or don't qualify for the practical expedient, well, as I said before, the first thing is to consider whether the rent concession is a lease modification or, if the lease contained a force majeure clause which covers a pandemic, a lease reassessment. If the rent concession is accounted for as a lease modification, then the normal rules in AASB 16 will apply. If the modification gives rise to an increase in scope and the consideration changes by an amount commensurate with the standalone price, then the modification is accounted for as a separate lease. If the modification otherwise gives rise to an increase in scope, or the scope of the lease is unchanged, then the lease liability is remeasured using a revised discount rate, and the right of use asset is adjusted by the same amount. And if the scope of the lease decreases, for example, the floor area leased is reduced, then both the lease liability and the right of use asset are decreased, which will have an immediate P&L impact, and then the lease liability is remeasured. And if you want to know more, there are a number of BDO publications. The links are on the slides, which will be made available after today's webinar. Next, I'm going to touch briefly on share-based payments. I'm going to look at the accounting for the situation where you have modified the terms of an equity-settled share-based payment arrangement, and also the situation where you haven't modified the terms, but your expectations as to whether awards will vest has changed. The first scenario to consider is where a company makes changes to equity-settled share-based payment awards that have already been granted. This could be through changing the terms of an existing award, or if an existing award is cancelled and replaced with a new award, and where this is designated as a modification. A word of caution here though, replacement awards need to be formally designated as replacements to qualify for modification accounting. Otherwise they will have to be accounted for as a cancellation of the old award and a separate new award. So I would suggest you talk to your advisors here and ensure that all the I's are dotted and the T's are crossed if you are doing this. But assuming modification accounting is achieved, then the accounting treatment depends on whether the fair value of the modified award is higher or lower than the fair value of the original award, noting that both these fair values are measured as at the date of the modification, not the original grant date. If the fair value of the modified award is less than the fair value of the original award, then, unfortunately, you don't get to reduce the expense to be booked. The grant date fair value of the original award is still what is recognised, noting that, because of the modification, the vesting period may have changed. And in particular, if any awards have been cancelled, then any remaining expense in respect of these must be recognised immediately. But if the fair value of the modified award is higher than the original award, then, as well as the original expense, there is an additional expense to recognise, being the difference between the two fair values. Again, if the modification has changed the vesting date of the award, then this needs to be factored into the accounting entries. With regard to modifications, a final point is with regard to awards that have already vested with an employee. That is, the full original AASB 2 expense has been recognised. Perhaps surprisingly, if these awards are modified before they are exercised, there may also be an expense to recognise. As with unvested awards, an expense is recognised if the modification increases the fair value of the award, measured at the date of modification. It may be, of course, that you haven't changed the terms of your share-based payments. Just to recap on what to do if your expectations as to whether they will vest has changed. For awards with service or non-market performance conditions, if the service conditions are not met, then forfeiture accounting is applied, and any expense previously recognised is reversed through profit and loss. The same is true for non-market performance conditions. Conversely, if an award has only a market performance condition, then the expense is recognised whether or not the condition is satisfied. For awards with multiple conditions, it is a little more complicated. If an award requires both a service condition and a non-market condition to be met, if either is not met, then the expense is reversed. And if an award requires both a service condition and a market condition to be met, then if the service condition is not met, the expense is reversed. But if the service condition is met, and it is only the market condition that is not, then the expense continues to be recognised. The same would be the case if an award required both a non-market performance condition and a market performance condition to be met. Then the expense is only reversed if the non-market performance condition is not met. And if an award requires either a market or a non-market condition to be met, then, assuming any service conditions are met, at a minimum an expense will be recognised for the grant date fair value of the award, adjusted for the likelihood of the market condition being met, whether or not either performance condition is met. But if the non-market performance condition is met, then the full grant date fair value needs to be recognised. Now, back to Ash to talk about going concern.
Thanks, Kay. So to touch on going concern, at our accounting update in June, we were facing a world of significant uncertainties, and as such, there was a big focus on going concern. We previously addressed the requirements under AASB 101, the assessment of going concern under the effects of the coronavirus outbreak, and the interaction between solvency and the going concern assessment. 6 months on, we generally have a greater understanding of the impacts of the pandemic, and fortunately for many of us, particularly in WA, the fears anticipated at the onset have not materialised. However, the environment is still ever changing and the going concern assessment is still critical. As we enter another period of change with the end to many government stimulus measures and protections, your going concern assessments will need to take these factors into consideration. Also, even though here in WA, we have fortunately mostly fared well over the past 6 months, many businesses may still be impacted by what is happening around the country and globally. We still need to consider how our major customers and suppliers are impacted. Are capital markets likely to retract? And will there be further disruptions to supply chains? In addition to this, the temporary safe harbour defence that was introduced in March this year ends on 31 December 2020. This temporary defence for directors from civil insolvent trading is basically a blanket protection across the board. Once this ends on 31 December, there is uncertainty in the market around how a director will take advantage of this temporary protection, and directors need to start preparing for this. Very relevant to the going concern discussion is the determination of assets and liabilities as current or non-current. The classification of assets is based on expectations. Are assets expected to be settled or consumed within the entity's normal operating cycle or within 12 months? If not, then these are classified as non-current. Changing times may mean asset classifications need to be revisited. The classification of liabilities as current or non-current is as topical as ever and still a key focus area for ASIC, with ASIC regularly releasing media statements where companies have been required to restate liabilities from non-current to current. In addition to this, the International Accounting Standards Board has deferred the amendments to IAS 1, presentation of financial statements, relating to classification of liabilities as current or non-current. Originally due to be effective for annual periods commencing on or after 1 January 2022, the new requirements will only apply from 1 January 23. However, in deferring these amendments, the AASB did note that the amendments clarify but do not fundamentally change the classification requirements. So looking at this amendment, I will highlight the key changes coming into effect. Firstly, the reference to unconditional rights has been removed from paragraph 69D because rights to defer settlement are rarely unconditional. They are often conditional upon compliance with covenants, as an example. Secondly, new guidance has been added in paragraph 72A to clarify that if a right to defer settlement is subject to the entity complying with specified conditions, the right exists as at the end of the reporting period only if the entity complies with those conditions at the end of the reporting period. The amendments to paragraph 73 result in classification which is based on the right to defer settlement and not intention. And the old wording in paragraph 69A notes that a liability arising from a bond convertible into equity of the issuer prior to maturity is classified as current or non-current according to the terms of the bond without considering the possibility of earlier settlement by conversion to equity. New guidance paragraph 76B clarifies that this exception only applies to bonds where the conversion feature is classified as an equity instrument under IAS 32. When classifying convertible bonds or notes with conversion features classified as liability or a derivative liability, entities cannot ignore early conversion options. In future, we could see convertible notes being classified differently in the financial statements, depending on whether the conversion feature fails the fixed for fixed criterion for equity classification. So as a reminder, even though these changes are not effective until 2023, these amendments are meant to clarify the current standard, and so the above point should be considered when determining the classification of liabilities. Okay, I will now hand back to Kay to discuss modification of financial instruments.
Thanks, Ash. Well, I spoke earlier about modifications to leases and to share-based payments, expecting that, in this changing world, these may have been changed. Another area where modifications are likely to have occurred is around financial instruments. Lenders and borrowers may enter into agreement to modify the terms of financial instruments such as bank loans. These modifications may take the form of reduced interest rates, modifications to payment terms, and grace periods for covenant violations. Entities should consider the requirements of AASB 9 for the modification of assets for lenders and liabilities for borrowers. These modifications will generally give rise to gains for borrowers and losses for lenders. Perhaps the most likely situation is that you will have modified your financial liabilities. The accounting depends on whether the modification is substantial or non-substantial. AASB 9 states that a modification is substantial if the discounted present value of the cash flows under the new terms, including any fees paid, net of any fees received, and discounted using the original effective interest rate, is at least 10% different from the discounted present value of the remaining cash flows of the original financial liability. The guidance for the treatment of modifications of financial liabilities that are non-substantial, and so do not result in derecognition, is unchanged from AASB 139. Accordingly, if a modification of a financial liability does not result in derecognition, any costs or fees incurred are recognised as an adjustment to the carrying amount of the liability, and it amortised over the remaining term of the modified instrument by recalculating the effective interest rate of the instrument. But if the modification is substantial, then the old liability is derecognised and a new liability is recognised, with the effective interest rate being calculated based on the revised terms. Any costs or fees incurred are recognised in profit or loss as part of the gain or loss on extinguishment and do not adjust the carrying amount of the new liability. And to finish this part of the presentation, a couple of points in relation to JOBKEEPER based on some of our recent experiences. For for-profit entities, the accounting for JOBKEEPER payments is governed by AASB 120, which requires the grant income to be matched against the related expenditure. AASB 120 is an old standard which continues to apply the matching principle. As a consequence, where salaries have been capitalised, say into the cost of assets such as inventories, PP&E or intangible assets, the JOBKEEPER grant income for these capitalised salaries must be deferred and recognised as income during the periods when the related salary costs are expensed, that is, as costs of goods sold or depreciation or amortisation of PP&E or intangibles. Now, this can be done by either deducting the grant income off the cost of the asset or by setting up a deferred income account. So, turning away from coronavirus now and to the new accounting standards and developments, a big sigh of relief. Over the past couple of years, you've successfully implemented the new revenue standard, the new financial instrument standard, and finally, the new leases standard. So, what's next? Well, you may not want to hear this, but AASBs 9, 15 and 16 aren't over yet. Transition is just the first step. Next, you need to manage these new standards on an ongoing basis. As Wayne used to say, systems and processes, systems and processes. Today, I'm going to focus on AASB 16. Earlier, I spoke about the changes to leases as a result of coronavirus and how these are accounted for. Well, that may be special circumstances this year, but there will always be changes to your leasing portfolio, whether that is adding new leases as older ones close out, or making changes to your existing leases due to changes in circumstances. All of these changes will need to be monitored and accounted for. This slide identifies the various changes that can occur and how they are accounted for. Highlighted in red are those changes that result in an immediate P&L impact, although any change to the lease liability and right of use asset will obviously result in changes to depreciation and interest expense going forward. Determining the appropriate accounting treatment will depend on what has changed. Has there been a new lease, or has an existing lease been terminated or modified? And for a lease that has been modified, is there truly a modification? That is, has there been a change in the contractual terms? Or is it that circumstances and expectations have changed, but within the context of the original agreement? The accounting then follows on, depending on the nature of the change. Other than those changes with an immediate P&L impact, the approach is to remeasure the lease liability based on the revised lease payments and adjust the right of use asset by the same amount. As we all know, the lease liability is calculated as the present value of the future lease payments, but in doing this, should we use the original or a new discount rate? You will see that some of these changes require using the original discount rate, whilst others require the use of an updated discount rate. I think it is worthwhile touching on a few principles here. If you have made a new economic decision, such as entering into a new lease or renegotiating the terms of a lease with the landlord, then that has been done in the current economic environment, so it makes sense to use a current, so a new, discount rate. Similarly, if you have determined the lease term has changed, that is, how long you are reasonably certain to lease the asset for, that determination will have been made now, and so a new discount rate should be used. Although here it's worth noting that an updated discount rate is also required because the lease term has changed, and, all other things being equal, the discount rate will change, the same as how the rate on 10-year government bonds is different to the 1-year rate. But, conversely, when you haven't actively changed anything, for example, a lease agreement always contained rent increases based on CPI, it is just this that only becomes known now, then the original discount rate is used because you have just maintained the status quo. You haven't made any new decisions. So we understand the accounting and why it is what it is, but there remains the question of how to manage this. Things to think about and ensure you are addressing include Does your finance team have the necessary capacity and required level of knowledge of AASB 16 to maintain the accuracy and validity of inputs into your lease accounting solution, whether that be Excel or a software solution? In particular, if you have lots of leases and they're consistently changing then, in particular with Excel, is your version control good enough? Next, as discussed on the previous slide, the accounting will depend on the nature of the change. Is your finance team across the difference between these and the accounting consequences? What about new leases, those that maybe come in through a business combination, as well as in the ordinary course of business? How easily can you set up the accounting for these? And for new contracts, not just leases, does your team have the capacity and knowledge to assess these and identify any embedded leases? And even before this, will they be aware of all new contracts entered into by anyone in your organisation that may contain embedded leases, so they even know to look for them? Transition made determining the discount rate to be used easier. If you were using the simpler modified retrospective method, then you just needed to determine the discount rate at transition date. But going forwards, leases will continue to be entered into. Do you have a process to update your calculations of what this discount rate should be? Month-to-month leases also continue to provide challenges. Whilst the legal commitment may be only a month, if the lease term, being how long you are reasonably certain to lease the asset, is more than 1 year, then the short-term lease exemption can't be applied. And again, does your team have both the capacity and ability to ensure all month-to-month leases have been identified and appropriately analysed? Now, hopefully you can answer yes to all these questions, or alternatively, they may be providing some food for thought. More likely, there may be areas where you may need assistance, and just a little reminder about our services here, whether that is BDO Lead, our software solution to manage ongoing lease calculations and journals, and that we're able to offer to clients with many leases or with only a small number of leases, or IFRS advice and assistance in analysing your contracts and leases. So that's one recently adopted standard. In terms of new standards, Ash is now going to talk through the new changes to Interpretation 23 and AASB 3.
Okay, so Interpretation 23 was effective for the first time for June 2020 year ends. And I would say this new standard probably didn't get the attention it needed given everything else impacting the June financials. So I will provide a brief reminder on what has changed. It is important to keep in mind the situations where IFRIC 23 will provide clarity and the situation where IFRIC 23 is silent. IFRIC 23 answers a number of questions, such as whether entities consider uncertain tax positions separately or not, the assumptions an entity makes, etc. IFRIC 23 does not deal with the actual computation of current and deferred tax, which is still covered by AASB 112. It is important to note that the IFRIC did not include guidance on accounting for interest and penalties associated with uncertain tax positions, which can be a common issue. For example, an entity may make a filing position that a certain item is deductible for tax purposes, but there is uncertainty around that, so a provision is recorded under IFRIC 23, as we'll go over shortly. If the issue is not brought up by the tax authority for, say, 4 years, when they eventually deny the deductibility of the amounts, there could be significant penalties and interest associated with the late payment of taxes. Sometimes the interest and penalties could become more material than the actual underlying tax itself. IFRIC 23 does not address how an entity should account for the interest and penalties on taxes that may eventually arise relating to an uncertain tax position. However, it should be noted that the basis for conclusions to IFRIC 23 provides some guidance on this issue. The basis states that interest and penalties that are deemed to be income taxes would be within the scope of IAS 12 and therefore IFRIC 23 as well. Determining whether interest and penalties are income taxes in the scope of IAS 12 depends on whether they are based on taxable profit, as this is a key aspect of the definition of income taxes. Here is a graphical representation of what types of uncertainties IFRIC 23 requires measurement of. At the top axis, we have the probability that a tax position will be accepted by the taxation authority. If the probability is more likely than not, i.e. less than 50%, then IFRIC 23 doesn't apply. IFRIC 23 applies when the probability of the position being accepted is not more likely than not. So if IFRIC 23 does not apply, then that position is used in computing the underlying tax balances for current and deferred tax. Applying this to a simple situation, if an entity believes it has a 99% chance of being successful in a very basic, non-controversial tax position, then that 1% of uncertainty does not have any measurement implications. On the contrary, if a position is not likely to be accepted, then the extent of that uncertainty is included in the measurement of the tax position, affecting the calculation of current and deferred tax. For example, if an entity filed a tax return which included a tax position concerning the taxability of certain revenue streams, and it was concluded that the filing position only had a 20% chance of success, then the current tax provision per the financial statements will not match the current tax liability as filed in the tax returns, as it will have to be recomputed under IFRIC 23. So IFRIC 23 mandates that the calculation of uncertain tax positions must be on the assumption that the tax authority has full and complete knowledge of your tax matters, and the concept of detection risk is not permitted to be included in the calculations. Paragraph 8 states that an entity shall assume that a tax authority will examine your books and records. At the end of the examination period, when the position is no longer uncertain, the provision is released to the P&L. In terms of disclosures, IFRIC 23 does not introduce any additional disclosures. However, it does emphasise some existing disclosures. The requirement under AASB 101, paragraph 122, to disclose judgments made in preparing financial statements. In the context of income taxes and uncertain tax positions, this might include the underlying interpretation of tax legislation, which would affect income tax positions. The requirements of paragraphs 125 to 129 to disclose sources of estimation uncertainty, including their nature and the carrying amount of these items. This may be complex and potentially difficult to do, in that disclosing areas of estimation of uncertain tax positions may involve sensitive matters that entities may not want to disclose. We need to step back and determine how significant the estimations included in accounting for income taxes are in the context of the financial statements as a whole. And finally, IAS 12, paragraph 88 requires disclosures relating to tax-related contingent assets and liabilities in accordance with AASB 137. This would apply even in situations where under IFRIC 23, an entity has concluded that the uncertain tax position is probable to be accepted. For example, assume an entity concluded a tax position was 55% likely to be accepted, and therefore the uncertainty was not measured under IFRIC 23. AASB 112 might still require disclosure if the effect of it not being accepted would be material. Moving now on to the new changes for this reporting season, and the good news is that there aren't many, as Kay discussed earlier. The key change this period is the amendment to AASB 3. After considering feedback from its post-implementation review of the business combination standard, the IASB recently made amendments to the definition of a business in IFRS 3. The new definition must be applied to acquisitions occurring on or after the beginning of the first annual reporting period that begins on or after 1 January 2020. So entities with December year ends will therefore be required to apply the new definition to any acquisitions that have occurred this year, and those with June year ends will be required to apply it to acquisitions occurring from 1 July this year. Distinguishing between an asset acquisition and a business combination is important, as assets and liabilities associated with the transaction are accounted for differently, depending on whether the transaction is a business combination or an asset acquisition. Some of the differences include how the acquirer accounts for any consideration that is paid in the form of equity instruments, how contingent consideration is accounted for, whether or not goodwill is recognised. There is no goodwill in asset acquisitions, which can be advantageous for entities, particularly in the resource sector, where goodwill often doesn't make a lot of sense. The treatment of deferred taxes on certain assets and liabilities. For asset acquisitions, the recognition exemptions apply, so no requirement to recognise deferred taxes. The treatment of transaction costs, which are expensed when dealing with a business combination, but capitalised under asset acquisitions. How assets and liabilities acquired are recognised, and the recognition of non-controlling interests. And under a business combination, the measurement period concept is introduced, giving entities 12 months to finalise their fair value accounting. So what changes have been made? In summary, the amendment makes it easier to get to the conclusion of an asset acquisition through the following changes. The amendment narrows the definition of outputs and a business to focus on returns from selling goods and services to customers rather than on cost reductions. It amends guidance on inputs, processes and outputs in paragraph B7 to align with the new definition. The amendment clarifies that to be considered a business, an acquired set of activities and assets must include, as a minimum, an input and a substantive process that together significantly contribute to the ability to create outputs. It provides extensive guidance on what is meant by a substantive process. And it also adds an optional concentration test as a shortcut way of concluding that certain types of acquisitions are not business combinations. The concentration test allows a simplified assessment of whether an acquired set of activities and assets is not a business. In other words, this is a shortcut way of concluding that the acquisition is not a business without having to conduct the detailed assessment required by IFRS 3. In applying the concentration test, paragraph B7b includes extensive guidance about what can be considered a single identifiable asset or similar assets. The concentration test is optional and it can be applied to some acquisitions and not others. So it's a separate election for each acquisition. Onto some more good news. Earlier last week, ASIC issued an extension for reporting deadlines. ASIC have noted that due to the disruption still ongoing from the pandemic, some entities may still experience difficulties in meeting reporting deadlines and therefore have granted a 1-month extension. The last 2 bullet points on the screen are the key ones. If you are a foreign registered entity, these extensions do not apply to you, which is the same case as was in June. And if you are a listed entity, the fact that ASIC has granted an extension does not necessarily mean that the ASX will also grant the extension. For 30 June, they did end up doing the same through issuing a class waiver. That is not in place yet, so usually what happens is ASIC does the extension and then the ASX decides whether to follow or not. We would expect that they will follow, but again, no class waiver is in place yet. It's important to note that ASIC did highlight that where possible, it's important to try and stick with the original reporting deadlines. Okay, and finally, another recent change that I would like to bring to your attention that will indirectly affect preparers of financial reports. And this is the significant revision to the auditing standard ASA 540, which is auditing accounting estimates. We would like to make you aware of matters to consider in preparing for and responding to your auditor's requests pertaining to their order of estimates and related disclosures. This standard will be applicable to audits with 31 December year ends and on. The standard focuses particularly around the auditors really understanding the process and controls in order to understand what drives the risk of material misstatement of an accounting estimate, how they apply professional skepticism, looking for indicators of possible management bias, and how they challenge assumptions used in calculating estimates. So you should expect greater scrutiny and questioning of your accounting estimates from your auditors, particularly around the areas of recent accounting changes on revenue recognition, leases, expected credit losses, and on other areas of estimates such as impairment calculations, provisions, fair value of assets, and reserve estimates. Preparers will need to brief audit committees on significant accounting estimates, particularly those that may have engaged more auditor work effort, as these are often complex areas of the audit and need to be reported appropriately and robustly challenged. There is also a publication released by the AASB called Audit Client Briefing, which goes through the important implications for CFOs and senior management responsible for financial statement preparation, and to make aware of matters to consider when preparing for and responding to the significant revisions to the International Auditing Standard. So on that happy note, that ends the accounting updates. Alan will now provide a tax update, and then time permitting, we can run through any questions at the end. Over to you, Alan.
Thanks, Ash. Good morning, everybody. So my name is Alan Hahn, and I am a senior manager in the corporate tax team here in BDO in Perth. And as Ash mentioned, I'll be running through with you guys just a real quick tax update, just covering a few key areas that have arisen over the past year, which, as everyone is aware, has been an interesting year for most, if not all. If there's any questions or clarifications that are required, I think my details were put in at the beginning of the presentation, but they will also be there towards the end. So please feel free to email me directly or give me a call, and I'll be more than happy to work through these areas in a bit more detail with you and your business. So the three key areas concern the loss carryback rules, the instant asset write-off concessions, and what the ATO refers to as the Next 5000 program. So with the loss carryback rules, as the name suggests, it relates to the carrying back of tax losses that are incurred in the 2020, 2021, and or 2022 income year to offset against taxable income in previous income years going back to the 2019 income year. So the concept of loss carryback, it might be something that you guys are familiar with. This was originally introduced back in 2012, 2013, but was then repealed in 2014. So the concept is more or less similar, where the way that this will be implemented is through the 2021 and 2022 income tax return. So this was introduced as one of the initiatives in the budget that was announced last month. And so from what we understand, given at the point of release, many taxpayers would have either completed their 2020 tax return or at least advanced it to a particular stage. So as we understand it, they're planning on implementing it from the 2022 income tax return and 2022. So this is something that really, there's not much that can be done at this point in time, but there's something to be aware of for the next income year. So more or less, if a corporate tax entity has turnover of below 5 billion, they will qualify. But with regards to two limitations, the key with this provision is not so much to give taxpayers an overall net benefit of sorts. The loss carryback rules are there to just reduce tax profits in a previous income year. So further to that, as a result of the potential decrease in prior year tax paid, naturally there's an impact on the franking account balance, where tax paid generally gives rise to franking credits. So the amount of losses that are carried back cannot create enough of a franking deficit to kick the overall balance into a debit balance. The next one we'll go over is the instant asset write-off concessions. So these concessions, in its purest form, have been around prior to this calendar year. So for those of you guys that are not aware, for certain entities that have aggregated turnover under certain thresholds, where they acquire particular qualifying assets under certain costs, those assets can be deducted immediately for tax purposes. Now, keep in mind, aggregated turnover also includes overseas parent entity income as well as overseas associates. So with COVID-19 arising this year, as you guys would recall, the government came out with a few stimulus initiatives to help impacted businesses navigate through the challenges that were presented. And so what they did was they took the instant asset write-off that already existed and they've pretty much broadened the net. So it increases the number of entities that can qualify. As you can see, the threshold test for aggregated turnover has gone up to 500 million and the cost of the asset is up to 150 grand, up from $30,000 previously. And then further to that, with the budget that was released last month, again, they have further increased the net where the aggregated turnover cap is up to 5 billion. So arguably majority of the entities in Australia will be able to access these concessions, but it's just making sure that you do tick off the relevant tests that do exist for these concessions. So the key things to consider is when a qualifying asset was acquired and what the aggregated turnover for the entity was, and that will help determine the application of these incentives. Now, only just yesterday, the government actually came out and announced that they were going to further expand the net. So with regards to the $5 billion cap, what they're now using as far as that test is focusing on statutory income and ordinary income. So more or less income that would be taxable in Australia. So what that provides for is entities that would have had aggregated turnover over a 5 billion by virtue of overseas parents and associates, because where that income for the most part wouldn't be taxable in Australia, wouldn't qualify as statutory and ordinary income, then those entities will also now be able to potentially access these concessions on the basis that they also satisfy other requirements concerning tangible depreciable asset acquisitions over the past 2-3 income years. So there'll be more of that will be coming out, we imagine, in the next few days and weeks. And then if we go to the next slide, this is just a quick snapshot of the interaction of the instant asset write-off with the small business entity simplified small business pool that some taxpayers will be utilizing. And all this is saying is where a small business entity has historically utilized the SBE pool, where they can utilize the instant asset write-off, they must, but then where the cost of relevant assets exceed the respective thresholds, then you're kicked back into the SBE pools. Now, one more thing just to mention overall, the ATO have acknowledged the interaction between the instant asset write-off and the loss carryback provisions. So this is, I guess, potentially a tax planning tool where any assets that qualify and are claimed immediately, which may generate tax losses, those losses can also be carried back to relevant qualifying income years prior to that respective income year. Okay, so lastly, we just wanted to cover off what the ATO refers to as the Next 5,000 program. So this follows on from the Top 500 program, which some of you may be aware of. And so the purpose of these programs that have been introduced with or by the ATO is to provide the wider community with confidence in Australia's tax system, where privately owned entities that are, I guess you could say, on the larger end of town are indeed paying the right amount of tax and complying with requirements set by the ATO. And as far as the Next 5000 program is concerned, private groups owned by Australian resident individuals who, together with their related parties, control wealth of more than $50 million. So they're captured under this program. As it is an extension of the Top 500, naturally, if a taxpayer is already subject to the Top 500 program, they're not going to be subject to the Next 5000 program. So the way the ATO will administer the Next 5000 program is through a streamlined assurance program. So they'll generally focus on what businesses or what private groups are doing, significant activities, transactions that they're entering into, and they will generally look at these things covering roughly 2 or so income years. Now, that can be a longer period of time where relevant. We are actually assisting with one at the moment that spans 4 income years. Yeah, I mean, this will all be communicated by the ATO if your business ever gets subjected to the Next 5000 program. And the way the Streamlined Assurance program is undertaken is through what they call a justified trust methodology. So the term justified trust is something the ATO have been coming at with a bit more. I guess it's just a framework that they are trying to roll out for application for taxpayers just to understand what the end goal is. And in applying this methodology, when they request particular information, when they ask certain questions, and we'll get to that in a bit, they generally center around 4 key pillars. So one of them being tax governance, where this really centers around how the qualifying taxpayers are addressing tax issues, how issues are escalated up the chain, how things are being reviewed, at what point, are tax issues addressed with the assistance of professional advisors. So just how they're really managing tax risk and tax compliance internally. The second pillar concerns tax risks flagged to the market. So these are areas that the ATO have already communicated to the wider market as being focus areas that I guess are deemed risky. So for example, a key area here concerns transfer pricing, which I'm sure you guys are aware the ATO has been quite vocal on over the past few years with a few cases coming out, commentaries and whatnot. So it's more to put it back on the taxpayer to say, well, based on all these areas that have come out, how has the business addressed them where relevant? The third pillar concerns new and significant transactions. So that's really pretty straightforward. And then there's book to tax reconciliation. So really, how does a taxpayer get from accounting numbers to tax numbers? So lastly, what we'll just quickly go over is the taxpayer experience roadmap. So this more or less is what the Streamlined Assurance Review will involve. So the key takeaways of this, so we just focus on just the top section of this slide. It's a process that can span 8 to 9 months, and that will naturally depend on the specific circumstances of the taxpayer, but more just to have an appreciation that, this thing isn't a, here's a call, questions, answer, done, but it does take a bit of time. And I guess the other key takeaway when you look at the steps involved, there's a few touch points with phone discussions, meetings and whatnot with the tax office and the taxpayer. So I guess the aim for this is to showcase that this is a collaborative engagement. So it's not so much an ATO, going out for blood and trying to find X, Y, and Z, but it's more just to have that collaboration between the tax office and the taxpayer, and naturally the tax agent will be involved. So at the moment, we've got quite a few on the go, which are more on the early end of this process. But yeah, it's a continuous collaboration effort where, it's more just giving the opportunity for the taxpayer to convey what they're doing, address risks that are relevant and what they're doing to, I guess, manage that risk going forward and how they can help ATO identify any areas that the ATO might not be aware of. So taking a step further, in the bottom section of that slide, you'll see the transition option. So obviously this option is a lot shorter, where this will span more so 2 to 3 months. And the key difference between the default roadmap and the transition option is that this is more a honed in approach. So it's more focused. So in the default roadmap, where you see step 5 and there's the receipt of an RFI or request for information. So from what we've seen, this spans about 70 to 80 questions. So it can be quite involved, but for some taxpayers, most of the questions might be applicable, for others, most might not be. So the ATO have acknowledged they haven't tailored these questions in any way. It's almost just casting the net wide. But the transition option is more focused and, as I say, more honed in to what the business is doing. So the questions will be more specific, but in turn, the taxpayer will get more time to respond to these questions. So this option, or the availability of this option, is dependent on taxpayer circumstances, where the ATO would generally progress with this transitional option where they deem appropriate. But this is something that naturally can be discussed with the ATO at the commencement of the Streamline Assurance Review, where from what we've seen, the ATO will go directly to the taxpayer in the first instance, whereas with, say, ATO reviews and audits that have gone on for, since way back when, in most cases that we've had, they'll come to the tax agent directly. So yeah, taxpayers will receive notification initially on this process. So that's pretty much the tax update in a nutshell. Obviously, there's a lot that can be expanded on those key areas. So as mentioned, if there's any questions or clarifications required, my contact details are in the slide there. So please feel free to email me directly, give me a call, and I'll be more than happy to assist your business further. So I think we'll end the tax update there. Thanks for your time. I'll pass it back to Ash.
Great, thanks, Alan. There were some very useful insights there. So apologies, everyone, for running over time. As we are well past 10 a.m, we won't go through any of the questions right now, but we'll respond to these individually over the next couple of days. Thank you all for joining us today on this webinar, and please reach out to myself, Kay, or Alan, or anyone at BDO for any further questions. I hope you all have a great day. Thank you.